Hello, and thank you for joining us today for our Ask Us Anything webinar. My name is Ryan Correia, co-founder and managing director at Equivesto. I'm joined today by my fellow co-founder and managing director, Alexander Morsink, to answer any questions you have about our investment round, about Equivesto, or anything in between. So let's get right into the questions, and feel free to raise your hand or drop a question into the chat at any time. Okay, Alex, the first question is, with current market conditions, is equity crowdfunding a good idea for investors?
It's a great question, Ryan. Just to sort of recap the market conditions so everyone's aware, there's a number of things kind of going on in the space, in the investment world in general. So firstly, I think the biggest piece is the inflation rate has really gone up quite considerably. So I think right now, inflation is sitting at over 5% per year. This has also had a bit of a knock-on effect when combined with the war in Ukraine and a variety of other things to cause the markets to fall, the public markets to fall somewhat. So stock prices are falling and interest rates are also going up. So it's looking like we might be moving towards a bit of a recession in the economy as a result of these sort of combining factors. The challenge with the inflation piece is usually when inflation goes up, that means that the value of money individually is going down as the total supply of funds, the total dollars in existence increases by the rate of inflation every year. So right now, because inflation is over 5%, essentially $100 today is worth essentially like $95 next year, the equivalent of $95. Or the value of a loaf of bread right now is $1, but when you buy the loaf of bread next year, it's actually going to be like, $1.05 or $1.10. And normally in that sort of situation, what you'd look to do is find an investment that is going to gain value greater than inflation. So when inflation is usually a more reasonable, 0.5% or 1%, when you're thinking about investing, you think about investing something, okay, if my investment is making me 5%, in reality, once you remove inflation from that, it's making you around 4%. With inflation all the way up at 5%, people will be looking for investment opportunities that are going to make them more than 5% return, so they at least don't lose money as a result of inflation itself. The challenge, however, is the public markets, stocks, which are usually a place where people would go if they're looking to have larger returns. Those are also going down. So not only are you losing money because your money is becoming worth less, but also investments are reducing in value as part of the recession. Oftentimes, investors can consider moving into returns or investments that offer fixed returns over the amount that is tied to inflation. The private markets also don't fluctuate in the same way that the public markets do. As you see in the public markets, people hear the news, and because there's public trading, there's trading anytime, people can go in, buy or sell shares as they see fit, and oftentimes the value of the markets will fluctuate quite drastically in response to people making these quick decisions to buy or sell. So right now, people see other people selling, the value of the stock is going down, people hurry to sell themselves, and that further reduces the value. Private markets, because they don't allow trading of the investments, are less short-term volatile in the same way that the public markets are. Also, even though they are higher risk, they do contain potential for larger returns. And so this can give people an opportunity to put their funds somewhere where it might make a bit more than they would normally or than would be being made in the public markets. When we're thinking about dealing with that combination of things, the fluctuation and volatility in the public markets, as well as the challenges associated with covering inflation, you're trying to find an investment that is going to help you safeguard against both of those things. Equity crowdfunding and investing in private opportunities can create an opportunity for you to avoid some things like that. If you're willing to take on slightly higher risks, there are investments currently available on Equivesto in private real estate opportunities that pay fixed annual returns greater than the current rate of inflation at 5%. So many of these also pay out a yield By yield, I mean an actual payment back to the investor on a quarterly or an annual basis. What this means is you can make it an investment in something that is going to be earning you more return than the inflation. And rather than your investment being locked like it normally would be for a private investment, the investment itself is paying back out returns to you at a rate that is going to be covering the rate of inflation. So even though investments in private companies are higher risk than public investments, investing in a private investment that is secured and backed by real estate can be a great opportunity for investors to diversify themselves away from the volatility of the private markets and into something that will be potentially earning enough to cover inflation, even when inflation is at 5%.
Excellent. I hope that answered your question.
Rather
okay, we got another one
but,
here.
Yeah.
For a founder, how does the VC downturn affect my ability to raise via equity crowdfunding?
Well, it's really, there is a challenging situation there for all founders. You know, anytime more capital is being deployed towards startups, to the entrepreneurial industry, to the startup ecosystem, that's always positive for all founders. And so when there's pullback and, you know, we hear about VCs potentially leaving the space, that is a challenge for all founders. However, VC capital was never and is still not the only way for founders to go and raise funds. VC capital is always very specific in the type of businesses that they're looking to fund and the demands that they place on those businesses. So even before, when there was a ton of VC capital, there was never a guarantee that VC capital was right for your business in and of itself. Now, with more VCs pulling back, there's more opportunities to founders to look towards alternative types of capital raising, including venture debt, including getting grants and loans and support from the government, including IRAP, but also including equity crowdfunding. Equity crowdfunding is all about bringing your crowd, your community of people who know and understand your business and believe in it to come and invest in your business itself. That model is based around having people invest in you who already understand your business, who believe in it, and it's about allowing them to invest in smaller amounts. So with VCs leaving the space, there's more opportunities for founders to consider alternative types of capital raising. And even with, you know, the overall potential recession in the market, leveraging your community and allowing them to invest in smaller amounts, so it's not going to put a pressure on their personal financial situation, might result potentially in a smaller raise, but raises still that are going to help you to grow and continue to expand your business. Also, investing in small businesses and startups. These businesses are, of course, still very much affected by a recession or something like that, but they're affected in a different way than a public company. Public companies' stock and valuation are plummeting, but the businesses are still operating. And private companies are sometimes, especially smaller ones, more insulated from larger chains like that. If a private company is doing great work and they are providing a critical need or service to their customers, that need or service will most likely still be there, even if there is a recessionary pullback. So the business might not be growing, you know, as astronomically as it did before, but there will still be core demand for their suppliers, and they will still be able to move forward. One of the largest growth areas that we saw is after the 2008 recession, the amount and explosion of innovation in the startup community and the growth in value in startups between 2008 and 2012 really was quite strong. And the 2008 recession actually created the idea in the American regulators to come up with equity crowdfunding, which was finally introduced in the Jobs Act in 2012 in the United States. So while there's no guarantee of any sort of, you know, repeat returns or anything like that, there's always opportunities for people to do something innovative and exciting, and the ability to bring the community in to support a business in more reasonable bite-sized pieces still gives founders an opportunity to, one, allow their communities to participate and continue to support the business, but two, still raise and access capital as needed. One thing I also want to add is the really large VC valuations that we've seen, which are sort of the immediate ones suffering, were valuations created as part of the American sort of Silicon Valley startup community. In Canada, investors and VCs are much more conservative than they are in Silicon Valley. And so we didn't see the same massive boom in valuations in Canada over the last 4 or 5 years like we did in the United States. I've had many conversations with founders reading information about raises in the United States where somebody went with just a pitch deck and their business was valued at $10 million, whereas in Canada, you would be lucky to get a $3 million valuation from an angel group, even if you have traction and fully developed ideas, but you're still pre-revenue. So that change and that higher risk, again, is coming to, the higher conservatism in Canadian investors is again coming to protect Canada from a financial perspective, just like it did in 2008. So even though we never reached the really high valuations that the startups and VCs did in Silicon Valley, there's also not going to be that same aggressive amount of pullback on valuations. There might be fewer VCs who are participating in the market, but it's not like companies are suddenly going to see their Canadian valuation slashed by 50% or 70% like a company might in the United States.
Excellent. Okay, next question. What, if anything, could cause your company to fail? Okay, so like any startup, we're susceptible to the same things that most startups are susceptible to. We actually outlined quite a few of these risks in our offering memorandum, so please give those a read. They're not all encompassing, but some of the main ones I would point out. Market risk. And that's definitely one of the top things that we're talking about. That's what Alex was addressing earlier. We can't predict the next pandemic, but actually Alex and I launched this company during the pandemic. So, we've had that sort of experience of working under extreme conditions, keeping the company extremely lean and making sure that we made it through and made it successful. So that's some of our experience has helped prepare us or something like that. But of course, we don't know what's around the corner. But as always, we are keeping ourselves, protected from those things by keeping a close watch day to day on how we watch our capital and pursue every step in our business. The other, I would say, major risk that we would bring to light would probably be our management risk. Of course, we're a small team like any startup, and a lot of the business is run heavily reliant on Alex and myself. And so one way that we're hedging that is of course, we want to bring in new talent and train these key members to delegate some of our tasks. So, as part of this round and as we grow as a business, some of those major tasks that Alex and I take on, we're hoping to delegate. So those are some of the areas.
One thing I would actually add, Ryan, to your great answer about how we can mitigate risks facing Equivesto and what we could do to potentially avoid some of those. The vast majority of businesses, especially startups, fail because of one thing, because of cash. They run out of cash and they don't have the cash flow management, enough funds coming into the business to keep them moving forward and being successful. If we think about how most startups grow, especially ones, like what we just talked about that are being backed by VCs, there's often a lot of pressure to grow and scale extremely rapidly. And in doing so, companies take on tons of new employees and tons of costs much faster than they grow their revenues. At Equivesto, Ryan and I have been focused on growing the business in a different way. We're focused on building profitability first. So on a month-to-month basis, we are often profitable at Equivesto, and that position and us continuing to be more and more profitable every month, that changes the way we're able to approach and manage, because we know, okay, we've kept the team lean, we keep the costs down, and we're able to, just through generating revenue and generating sales, cover the cost of operating the business, which means it doesn't matter if there's any change to sort of capital situations or things like that, because we're operating the business in a profitable way, then we're already able to survive just based on our revenues. And so that really changes the situation for us compared to many other startups in the space.
What actions are you taking to recession-proof your company? Yeah, so as Alex mentioned, operating as lean and as mean as possible. We've always done this. keeping our burn to a reasonable level. That's really where we're going to be focusing over the next 6, 8, 12 months on our business is keeping a close eye on our burn, focusing on our strengths. If you look at our deck and our campaign page, we really want to focus on quality over quantity. So keeping our attention spent on putting up quality companies, working on our customer experience, we think that will lead to our success. Spend less money on ads. Alternatively, we can spend more time on developing content and relationships. We think those are excellent areas that we can drive more business and better business and higher quality business to EchoVesto. And then I think all in all, taking it slow and calculated and being as patient as possible. Like I mentioned before, we experienced that when we launched this company during the pandemic. We didn't really know what tomorrow would bring, but we knew we had a good business, our model was sound, and we were being efficient with our capital. Okay. See if there's more questions here. Okay. If you raise less than your maximum goal, will you still be able to achieve the goals laid out in your plans?
I can take this one if you want, Ryan.
Sure.
Yeah. So as we kind of touched on a bit earlier in the previous question, we are building and running EchoVesto on the basis of achieving profitability and maintaining profitability and growing through our profitability. And so what that means is all of our plans, all of the goals that we've outlined as a business, there are already goals that we are working towards on our own without raising any additional capital. For us, this raise was really more about allowing the community to come in and support us and to expedite the time to achieve some of our goals. And so we have outlined and built out, clear milestones for many of those goals and the order with which that we'd like to tackle them. And so if we don't raise the full 1.5 million, that's totally fine. We'll just be able to use the capital that's raised to tackle some of the initial goals faster, but we will still continue at our regular pace to eventually achieving all of the goals that we've outlined.
Excellent. All right. Something about the investment process. What is the investment process on EchoVesto? How does someone sign up? I'm assuming is what they're asking.
Okay, perfect. Yeah, so we've designed to try to make the investment process as simple as possible. We also have some specific articles with clear screenshots in the EchoVesto Learning Center, which takes you through step by step to see the entire account creation process and investment process on EchoVesto. But essentially, you go to echovesto.com, you can click on the investor page and choose to sign up as an investor. Once you provide your information and verify your email, then you'll be taken to your investor forms. They take 2-3 minutes to complete and give us personal information about you so that we can help set the right investment limits for you based on your financial position and your risk profile. Once your profile is fully submitted, it'll be reviewed and approved by a member of our team. Then your account will be open and available for you to start investing. You receive an email with your investment limits, and then you can review all the offerings on the EchoVesto page. You can see those companies and choosing a company you like. You can click onto their campaign page, review all of the details, including the offering document attached at the bottom, and then you can actually proceed to making a transaction. We've set up the profile and the platform to be as easy as possible for people to make online seamless transactions. So you click on the company you'd like to invest in, you choose the amount you'd like to invest, you digitally sign the investment documents, and then you provide your Canadian bank account information to actually move the funds and complete the transaction.
All right, excellent. What's the deadline to invest? The deadline is May 31st at 11:59 p.m. Eastern Standard Time. So
correct. Yes.
That is the final countdown, ends at 11:59 p.m. on the 31st. Okay. Will you do any future equity crowdfunding raises? Yeah, we're excited about this current community round and this opportunity to give our community a chance to be part and be in what we call an Equibacker in EchoVesto. We know that many of the other equity crowdfunding platforms have multiple campaigns over the years. That's certainly in the back of our minds. We're open to considering future rounds, but we don't currently have one in the plans as of yet. But yeah, right now we're super excited to bring in this new batch of equi backers into our business. And yeah, we'll consider it. We'll consider it in the future. Post raise, what are your immediate plans? I think this is a little bit similar to your answer before, Alex. But yeah, our immediate plans, after our raise will be, of course, focusing on bringing in more retail users. So we're really about creating more content and quality content for our investors so that they can get better educated about the private markets. I think that's one of the main areas that we want to focus this year, is developing more content to help people start to angel invest. And as part of that, also reaching out to a wider audience. So we're going to be looking to go across Canada in the next 6 months. So really our goal is to start the process in that direction. I think those are the two main goals. Of course, all the education that we're going to be creating is going to be free. We really want to be and continue to be accessible to anyone who wants to learn about the private markets. Yeah, and also developing our partner network. That's something we can do for free. It doesn't, cost us anything. It's just a matter of time and energy to go and start to develop better partnerships. Okay. Remind me how EchoVesto makes money.
Perfect. I'll grab this one, Ryan.
Sounds good.
Yeah, so EquiVesto Inc., the parent company, actually makes its money through fees and everything that are paid to it by its underlying subsidiaries, including EquiVesto Canada Inc., which is actually the licensed exempt market dealer. EquiVesto Canada Inc., the exempt market dealer, makes funds in really two ways. All of the fees and all of the revenue for EquiVesto Canada are earned from companies. And so companies pay us two fees. The first is an application fee to get started with the process and for us to go through the due diligence on the company. And then the second is a success or a brokerage fee, which is a percentage of the total amount raised by the company through the EquiVesto platform. So the vast majority of all of EquiVesto's revenues come from those two fees, which are then passed up to the parent company to help cover expenses.
Great. When will I see return on investment?
Yeah, it's a great question. With any private investment, there are really three avenues with which an investor can see a return on their investment. The first is if the company goes public and IPOs, and then they are able to sell their shares, and the shares have gone up in value since they purchased them. This is basically a capital gain on your original investment. So that's one angle. The next is if the company itself is acquired. So same sort of thing. It's a capital gain on the value of the securities you purchased. If the company is bought and all of the shares are bought by another corporation or another business, then that's an opportunity that an investor can get their return. And then the final option is a dividend. So dividend income can be earned for investors when the company itself takes some of its profits and chooses to pay those profits out to investors. So of the three potential options, EquiVesto is currently really considering the option of the dividend income and the acquisition. We see a lot of growth in equity crowdfunding platforms internationally, and going and creating a platform in Canada and getting licensed is a lot of work, just as it is in any other country. And so we see really large, almost billion-dollar sized American platforms looking at acquiring existing platforms in other jurisdictions as part of their plans to expand. So we see that's already started happening to UK platforms. So the likelihood that they start considering making acquisitions of Canadian platforms in the next 3 to 5 years is pretty high. Also, as we mentioned earlier, EquiVesto is built around profitability first. So part of our internal plan is not really based on being acquired, but is also about growing the business and continuing to service more and more clients to the point where we can start to pay out dividends to our investors.
Okay, great. Does every startup on EchoVesto have such a long time horizon to return?
That's a great question. So EchoVesto has a number of different investment opportunities on the platform. Some of them are small businesses, some of them are startups, and some of them are more real estate focused investment opportunities. So typically with an investment in the private market, just in a sort of general sense, though this isn't applicable in every scenario, most likely the opportunity for an investor to sell their investment is going to be extended by a number of years, and that the result of the capital being locked away is potentially going to result in higher returns for those same investors. So typically when a startup is coming to raise on the platform, and again, you'll need to review every company's offering individually to see their own goals and timelines. But typically you would see a startup looking to really reach profitability and start paying returns to investors in potentially 5 to 7 years. Small businesses, sometimes that timeline is shorter because they're already operating, they already have their location, and they're looking to start paying out dividends in a maybe a 5 or a 3-year time period. Other real estate investment opportunities might be combining a dividend income with a capital gain. So a payout at the end when the investment itself is sold, but also payments in the middle to investors, which come on, potentially a monthly or a quarterly basis. So there are several investment opportunities in the real estate space on EchoVesto that are paying out returns to investors as time passes, as well as potentially at the end. And finally, there are some startups on EchoVesto that are raising funds, not really to gather the funds themselves, but simply to grow the number of investors in their company to help them IPO as quickly as possible. Companies need 150 shareholders in order to go public. Equity crowdfunding is an effective way to gather those 150 shareholders. So sometimes there are businesses raising on EchoVesto where really the goal is to get that 150 shareholders so they can proceed with a public listing as quickly as possible. Now, there's no guarantees for those businesses around how long it's going to take them to actually complete a listing, but oftentimes their goal is to list within the next year or two. So that is a much shorter potential timeline between being able to sell your investment once they go public.
Okay, that's great. We have a question here from actually one of our investors. I've already invested. When will I be issued my shares?
Essentially, the process of investing through EchoVesto or through an online portal like ours, essentially the company is open and available for investment. And during the campaign, the funds are being gathered by the platform, by EchoVesto, in a segregated account. Once the campaign closes, or if it has a monthly closing, then every month, that's when all the documentation is reviewed. It's gone over with the lawyers and then filed with the regulators. And at that time, the funds are moved to the company and the shares are actually issued. So after the closing takes place, usually within 2 to 4 weeks of the closing, that's when the shares will be officially issued to investors.
Excellent. How often should I expect updates from you?
So as part of our campaign, we outlined the frequency with which we will be providing updates to our investors. Obviously, we have the EchoVesto newsletter that goes out every 2 weeks, but we'll be providing an investor update to all investors in the EchoVesto campaign on a quarterly basis.
Excellent. All right, this is a great question here. Since the beginning of your campaign about a month ago, I noticed you updated your numbers from 3,000 members to 3,500 members, raised dollars from 3.5 million to 4 million, and 20 plus campaigns to 25 plus campaigns. Are you really growing that fast?
Yeah, well, yes, we are. We continue to have more and more companies reaching out to raise with us. Where part of the reason why we're raising this capital is to be able to grow and expand our team as quickly as possible to deal with the huge volume of demand for our services. And as VCs pull back, there may be even additional demand because there's less VC capital available. And that additional demand results in additional number of investors signing up to invest and additional amounts of capital raised. So we're continuing to grow quite rapidly, and we're very excited to grow ourselves to keep up with that demand.
Excellent. And here's another one. Now that there's so many options, as an investor, how do I decide which investment is right for me?
It's a great question. Choosing an investment, certainly an investment on EchoVesto, is an important decision. So before going any further, it's really important to review and understand all of the details on any offering you're considering. So review the campaign page itself. Make sure you're signed into EchoVesto so you can also see all of the documents attached at the bottom of the campaign page. Specifically, reviewing the offering document or the offering memorandum, while a long document is also important because there's a ton of great details for investors in there that it's important for you to know and understand about making an investment. Then it's really about comparing the investment that you're considering with your own goals. Are you looking to save up in the short period of time for the deposit on a house, or are you looking for a much longer time horizon to get your funds out? Depending on the time horizon of the investment and when they might start expecting to see returns, you should make sure that that's aligned with your personal goals. Next, think about what you want your investment funds to be doing and what you would like to put your money towards, and make sure those goals also align with the businesses that you're considering. If you have multiple businesses that seem to be similar, or you're looking to have some additional advice, feel free to reach out to EchoVesto. We have dealing representatives that are licensed to provide financial advice to you about investment opportunities on EchoVesto, and we know all about the offerings on the campaign, on our campaign pages. So definitely have a look at the details on the campaign page, but also feel free to reach out if you have questions. At the end of the day, our goal is to make exciting investment opportunities that previously were not available to the public, available to everyone. And so review the opportunity, and we try to keep the investment minimums as low as possible so that more people can participate. And when they are participating, they're able to diversify their investments across multiple opportunities. It's important to not put all of your eggs in one basket, because you never know what could impact one business might not affect another. So we do recommend investors on the platform diversify their investments across multiple opportunities.
All right, I guess with that, we'll close out our Ask Us Anything webinar. If you have any more questions, feel free to email us at support@equivesto.com. And for those interested in investing, you have less than, I think, 11 days to participate. So, and also note that it could take up to 24 hours for your account to be approved, especially when, a campaign is ending. There's a lot of volume. So really give yourself some time, some extra time to set up your account if you're new to EchoVesto, and visit equivesto.com for more details. Thank you, everyone.
Thank you, everyone, for joining. It's great chatting with you today, and I hope you all have a great long weekend.